Hey everyone, welcome back to the channel. Today, we are opening the archives to look at one of the most important documents in financial history, Warren Buffett's 1976 shareholder letter for Berkshire Hathaway. This letter is a pivot point. In the letter, Buffett revealed his 4 rules on pick stocks. If you look at the letters from 1974 and 1975, the mood was grim. The stock market had crashed, inflation was rampant, and the textile business was dying. But 1976? This is the year the rocket ship took off. Buffett starts the letter with this incredible opening line. After 2 dismal years, operating results in 1976 improved significantly. He wasn't kidding. In 1975, they were just hoping for moderate progress. But as Buffett wrote, earnings exceeded even the high end of our expectations. They brought in over $16 million in operating earnings. But here is the number Buffett actually cares about, and the one you should care about too: return on equity, or ROE. In 1976, Berkshire hit a ROE of 17.3%. Buffett notes that this was moderately above our long-term average and even further above the average of American industry. This letter is where we see the modern Berkshire Hathaway really start to take shape. It's where he defines his 4 rules for investing. It's where he teaches us how to handle a failing business, and it's where he reveals his secret weapon in the insurance game. So, grab a notebook. We are going to break down the 1976 letter, section by section, to find the lessons we can apply to our portfolios today. Let's skip straight to the part of the letter that every value investor needs to memorize. It's in the section on insurance investment. In 1976, Buffett made a statement that explains exactly how he picks stocks. He admits something surprisingly honest here. We simply can't find 100 different securities that conform to our investment requirements. Think about that. There are thousands of stocks on the market. But Warren Buffett, the greatest investor of all time, says he can't even find 100 that are worth buying. So, what are these strict requirements? He lists 4 criteria. If a stock doesn't pass these 4 tests, he doesn't touch it. Rule number 1: favorable long-term economic characteristics. He's not looking for a quick flip. He wants a business with a moat, something that will be winning 10 years from now. Rule number 2: competent and honest management. We're going to talk more about this later when we get to the textile section. Buffett needs managers who tell the truth when things go bad. Rule number 3: purchase price attractive when measured against the yardstick of value to a private owner. This is key. He doesn't ask, is the chart going up? He asks, if I were buying this whole company privately, would this price make sense? Rule number 4: an industry with which we are familiar and whose long-term business characteristics we feel competent to judge. This is the famous circle of competence. Buffett writes, it is difficult to find investments meeting such a test, and that is one reason for our concentration of holdings. Look at this table from the letter. You don't see 50 stocks here. You see massive concentration. The biggest holding? The Washington Post Company, valued at over $10 million. And look at this. Government Employees Insurance Company. Do you know what that is? That's GEICO. In 1976, Buffett loaded up on GEICO over $19 million in preferred stock and $4 million in common stock. He put nearly a third of their total equity portfolio into this one distressed insurer. That takes guts. But it fit his 4 rules perfectly. He sums up his philosophy like this. We feel quite comfortable concentrating our holdings in the much smaller number that we do identify as attractive. Today, we are told to diversify, to buy the whole index. And for most people, that's right. But if you want results like Buffett, you have to understand that he did it by waiting for the perfect pitch and then swinging hard. Now, it wasn't all grand slams and home runs. To understand Buffett, you have to see how he handles failure. And in 1976, the textile division was a failure. He doesn't sugarcoat it. He writes, our textile division was a significant disappointment during 1976. He says the earnings were inadequate. Now, most CEOs would blame the economy. They would blame inflation. And Buffett does mention that industry conditions were bad. But then he does something you rarely see in corporate America. He blames himself. He writes, "But equally important were our own shortcomings." He explains that they messed up the marketing at the Wambach operation and that unfavorable manufacturing cost variances were produced by improper evaluation of machinery and personnel capabilities. Basically, they bought the wrong machines and hired the wrong people. But watch how he treats the manager of this failing division, Ken Chase. Buffett writes, "Ken Chase, as always, has been candid in reporting problems and has worked diligently to correct them." He calls Ken a pleasure to work with even under difficult operating conditions. This ties back to rule number 2, competent and honest management. Buffett values candor, honesty, above almost everything else. He knows the textile business is tough. He admits, it should be recognized that the textile business does not offer the expectation of high returns on investment. So why did he keep it? Why didn't he just shut it down in 1976? Because of his loyalty to the community. He writes, "Nevertheless, we maintain a commitment to this division, a very important source of employment in New Bedford and Manchester." He was willing to accept lower returns to keep those people employed, as long as the losses weren't catastrophic. It shows a human side to the oracle that often gets overlooked. Okay, let's pivot to the engine that was printing money, insurance and banking. In 1976, the insurance business was on fire. The combined ratio, which measures profitability, dropped from 115.4 down to 98.7. In insurance, anything under 100 is profit. This was a massive turnaround. But Buffett gives us a masterclass in cycle thinking here. Everyone else was celebrating the high premiums. But Buffett was worried. He warned, present rates, which are adequate for today, will not be adequate tomorrow. He predicted that temporary prosperity produces unwise competition, and that by 1978, the industry would be in trouble again. His strategy? We must be prepared to meet the next wave of inadequate pricing by a significant reduction in volume. This is the discipline of a great investor. When everyone else is greedy and chasing volume, Buffett is getting ready to walk away. For the banking business, we have to talk about Eugene Abegg. He ran the Illinois National Bank, a subsidiary of Berkshire at the time. Buffett loved this guy. He compares Abegg's bank to National City Corp., one of the best big banks of the time. National City earned 1.34% on assets. Abegg's bank? They earned close to 50% better, or approximately 2% of average assets. How did Abegg do it? Buffett lists 3 things. He paid maximum rates to savers. He kept incredible liquidity. He avoided bad loans. And he did all this while keeping employment levels flat since 1969, even though deposits tripled. That is operational excellence. So, what do we take away from the 1976 letter? We see a portfolio that is heavily concentrated in just a few winners like the Washington Post and GEICO. We see a management style that demands honesty even when the news is bad. And we see a disciplined approach to business cycles, refusing to chase growth if the prices aren't right. But I want to leave you with one final thought from the letter regarding the stock market itself. In 1976, Berkshire's bond portfolio had some unrealized gains. The stock portfolio was up, but Buffett tells shareholders to ignore the fluctuating prices. He writes, "We consider the yearly business progress of the companies in which we own stocks to be very important. If the business results continue excellent over a period of years, we are certain eventually to achieve good financial results from our stock holdings, regardless of wide year-to-year fluctuations in market values." That is the secret. Focus on the business, not the ticker symbol. Thanks for watching. If you enjoyed the video, hit the subscribe button to support the channel, and I'll see you in the next one.